going to get back to, actually we'll finish chapter 1. We cover chapters 1 and 2 together. Don't know how far we're going to get to 2. Again, pace is not the issue. It's to make sure that you have all your questions answered. So in the second module in chapter 1, we're going to continue with the definition of accounting. We're going to focus on user groups today in the financial reporting environment. We're also going to talk about the social science aspect of it more, looking at the factors that influence the accounting profession. Then we're going to look at the generally accepted accounting principles, what we mean by that, and the history of standard setting in the United States, which again, you might say, well, why is that important? Well, because you'll see these terms, and especially if you're doing a CPA exam, there's questions that come up about these various organizations. You need to know where they came from. We're also going to look at the role of financial accounting standard setting in the United States, and then we'll briefly discuss the standard setting process to show you it is a political process where individuals, firms, governments can actually vote for the standards. So if you're thinking that the standards are in fact dictated by the FASB, that is not true. A due process system is in place to allow everyone to have input into the final accounting standards that we're using. Now, we looked at 3 aspects. We said financial information, user groups, and social science. The first aspect we've already covered. The second aspect in the user groups, and we've already talked about the fact that we've got multiple user groups, meaning that we've got investors, creditors, government, labor unions, insurance companies, financial analysts, so that we've got multiple users, and therefore the financial statements cannot satisfy their needs individually, but we try to best satisfy as much as we can simultaneously because of this wide spectrum of users. And that's why we have the term general purpose financial statements. But if we think about the focus, look at the terminology. The FASB thinks of the individual investor first and then the creditor. So I think if you look at the FASB's perspective, they're going to look at the investor and creditor. And when we look at the creditor, we're not only going to think about banks that are lending money, we're also going to think about suppliers who provide credit when you buy inventory, when you buy supplies. The other important point here is that the investor has to be a reasonably informed user. So we don't expect everyone to pick up a set of financials and understand them. You have to have some background. So there is a way out, in a sense, to the FASB that we can say that we expect the user to be reasonably informed. Now, when we look at the users, let's go through the groups. So we know we have equity investors. I'm not going to go through all of them, but just in general. So these are the shareholders of the company. So you realize that the shareholders need the information to make decisions whether to hold the stock or sell it. Creditors or other debt investors would be banks or other financial institutions that provide credit. Competitors, of course, competitors will look at information that you provide with respect, look at Nike. We talked about this when I did the review on Sunday, that we look at the management's discussion and analysis, and Nike is telling their competitors, maybe not all the details, but giving them information regarding where their sales are coming from, what's the biggest percentage of their business, where their market share is increasing or decreasing, and the competitors will use that information to determine whether or not they need to do a little bit more advertising, or maybe they need to change their product line as well. Financial analysts, this is where you have what we call it, you see this defined on the bottom, indirect interest users, someone that is using information for your benefit or somebody else's benefit. So this would be those employed at investment banks, brokerage firms, or financial advisors. Then we have employees and labor unions. And how do you think employees and labor unions use financial information? So anyway, I'll start next week. We're going to get once we drop in. I know it's completed this week. We need to get a final roster. I'll get back to calling on you. But how does an employee use financial information?
Maybe to determine how to use their full payment method?
Yeah, okay, so that would help, exactly. That would help your 401k if you're investing or holding the company stock.
It just says you can ask them for a raise. Well, with labor unions.
Yeah, exactly. Yeah, no, he's right. I mean, labor unions, we're gonna find out. You know, I'm gonna ask a question at some point. Why would you want to show lower income? And you can. You look like you're making less money, so if the labor unions come to you and say, we want to raise, I'm sorry, we are not making as much as we should. Now, if you understand accounting, and hopefully the labor unions have some good accountants, they could say, oh, you know what? You just changed to the LIFO method, and you lowered your income. That's nonsense. You got cash, pay up. That's the point. So we got to look at the cash flow statement, we got to look at income, but that's a good point, and your point is also important as well. And in addition, when you're looking for a job, you know, why is Crow telling me yesterday that their growth was extremely significant? I mean, if the company wasn't growing and they were the 9th biggest accounting firm and their revenues are level, you might say, well, it's a small firm, who knows if they're going to be absorbed. If somebody buys them, the smaller the firm, the more likely it is they're going to be absorbed by another company. And if that's the case, what happens to you? So even a potential employee is going to be looking at financial information. Now, suppliers, of course, are just like creditors. That's what I said before. Somebody supplying them with goods and services is going to be looking at your financial statements. I'm not going to, give you a line of credit to buy inventory unless you are financially sound. Here's another good question. I think you might not think so, but I think so. How do customers use financial information? You're a consumer. Do you ever think about the profitability of a company before you buy their product? What if it's a really expensive product, like a car? Financial crisis, 2008. General Motors just about to go under. Would you have bought a GM car? Probably not. Exactly. Warranty. So think like an individual and you'll think like a business. And it's the same notion. If the business is not doing that well, just like now, if you're thinking about, and it's funny because I asked the question sometime in intro, anyone have a BlackBerry? I mean, and don't be embarrassed, raise your hand, So, I loved it. I mean, I really loved it. I'm not big on the thumbs on a touch screen. I like to feel when I'm typing. Afraid to get one. How long are they going to be in business? Not that you hold the phone all that long, but are they cutting back on their support? If they're not turning a huge profit, their support may be not as good as it used to be. So, same idea. Yeah, Tom.
Companies going under when their better sales to their customers.
Well, yeah, at that point, but I mean a long-range relationship with that company. So something like an automobile in particular, where you got a 4-year warranty, and that's why I use automobiles, and Andrew picked it up. You have to, establish a long-term relationship with that company. So, for example, General Motors shuts down Oldsmobile. Chrysler shut down Plymouth. It doesn't mean they couldn't service your car in another dealership, but if the entire company goes under, who's going to service that car? Right? If there are, especially recalls, how are you going to get recall notices? So there is an important relationship. Yeah, now Toys R Us, of course, going out of business, if you walked in there, you can get a pretty good deal on whatever was left. Right. And of course, government agencies, taxing authorities, the SEC, etc. Also, which you might not have thought of, the regulation, Federal Trade Commission is going to look at your revenues to determine your market share. They're worried about what? About monopoly positions. So if you're absorbing too much of the market, they may come in and ask you to break up your company. Right? So the Federal Trade Commission will approve mergers or ask you to divest some of your interest if they feel that it is not going to be beneficial for the economy in general. So regulation can use the information that you provide. And we've just described some direct interest users like investors, creditors, and government. They're using your accounting information for their own benefit, and they're in that group, there are indirect interest users who are making economic decisions for others, like financial planners, investment analysts, and advisors. Now, again, the thing we said, I think the most important thing to think about is that we really don't know on 100% how people are using this information. So the general purpose financial statements try to find the best option to provide the best information, the most information at the least cost. All right, so that takes care of the users. Any other questions about the users of financial information? Third aspect, idea of the social science, the idea of the environment in which accounting operates. What I want to do first is I want to define GAAP. So if you haven't seen generally accepted accounting principles defined before, notice that they are broad reporting guidelines. They're not rules or actual laws. They're just guidelines that represent the best alternative methods out of many possible alternatives. There's a couple things in there that we have to think about. Number one, they're broad guidelines. So you're going to be told that you have to depreciate an asset and you have to come up with a useful life. Does anyone tell you what the useful life of the asset has to be? No, it's up to the company. You've got a guideline. Also, there are multiple methods to depreciate that asset. You choose from several different alternatives: straight line, declining balance, units of output, as we'll see later on in the course. So the choice of the method is also subjective in a lot of ways. You know, why would you pick one method over another? We're going to talk about that in a second. And what is considered best will change over time. So, as we said, you're going to be going through lots of standards, particularly in intermediate accounting 2, that are extremely significant, that will affect financial valuation, but will absolutely not be around for your entire career. So these will change, and why does accounting change? We'll see. It responds to changes in the economy, changes in the environment, changes in financial products. So what's best now is not necessarily going to be around for a long time. Now, the idea of having these guidelines, I think it limits GAAP. And in a sense, by having so many alternatives, it limits GAAP. I mean, if you had your way, would you want to see only one method of accounting? So why just not use straight line? Why only, not only use FIFO? Why do we give people choices? You ever think about that? In intro, I mean, you must have studied different methods, right? Did you ever think about why we give people different methods? Choices? Anyone? Why would you give somebody a choice of methods? I mean, they can use them to manage earnings, manipulate income, but what do you think was the real purpose? Yeah.
Is it just because not every company is the same?
Yeah, okay, so, all right, that's good, because it's a uniqueness of the company. So what you're trying to, the purpose, and it's not, by the way, that's the ideal goal, but it's not what happens in practice. The ideal goal is to say, we're going to give management the opportunity to signal their cash flow expectations, to signal their business operations through the methods that they use. And that's the purpose, to try to give management the ability to provide you with a signal or with a bit of information about their company. And every company is unique. Every company is unique. And you will find out, however, that most companies follow standards along industry lines. So everybody in a certain industry will use a certain method. People don't want to be that different, by the way, because if you're too different, it may raise a red flag. And one of the things you'll find if you ever start doing accounting research, if you have to do an accounting project, you'll find out there's a book that's published by, they mentioned the AICPA yesterday, the American Institute of CPAs, which we'll talk about in a bit. There's a book called Accounting Trends and Techniques, which tells you the most popular methods that people are using and the methods that are used by industry. So you'll know if you just started your own business and say, well, I'm going into a particular industry, what's the most common method to use to account for inventory? And you'll find out. Now, I think it's a limitation in a way because it raises questions, but you have to remember that we think that GAAP satisfies the primary objective of accounting, which is to allow users to make rational decisions, and therefore it will improve the confidence in users to know that there's a general set of standards being used. Now, what raises more questions, I think, and something that you probably may not think about often is that aside from market risk and business risk, there is something known as accounting risk. And the accounting risk deals with this problem of having this broad terminology and the vague and subjectivity and the discretion that we give management. So there are three areas that you have to be careful when you look at in terms of discretion. And these are, number one, the initial choice of GAAP. So why did someone, and we mentioned this a minute ago and I had a good answer about that one, why do you choose one method over the other? Why do you choose one method over the other? And it could be to reflect the uniqueness of your business operations. It may not be. It may not be. It could be for some other reason, which you'll find out. The bigger problem with accounting risk is here, changing from one method to the next. When companies change methods, or can they? Yes, they can. You can change from one method to the next. You can't do it every year, but you can change accounting methods. Maybe the nature of the business changes, to go back to that answer. Or maybe management wants to reflect something different. They don't want to raise income or lower income. So that's something you would have to determine as an auditor when assessing the risk of this company. Not only is it business risk or audit risk, it's also accounting risk. And then here's the big one for us when we become auditors especially, it's the judgment and the flexibility that we give managers in applying GAAP. Use of estimates, much more significant under IFRS, much more judgment under IFRS. But nonetheless, when we think about GAAP, there is a significant amount of judgment that management is going to use in applying the standards. All of us buy the same asset. All of us use straight line depreciation. The numbers are exactly the same except for one thing. You use a 10-year life and no scrap value. I use a 15-year life with a $5,000 scrap value. Somebody else may have a different scrap value and useful life. These are estimates. These estimates can change. When we talk about IFRS, one of the things, I don't know if you picked this up in the intro class, but one of the things you have to think about under IFRS is the fact that they are what is known as principles-based standards. In the United States, we have rules-based standards. So in the US, predominantly, not always, but the US is primarily we look at their standards. They are primarily rules-based. IFRS, that's US GAAP, of course, is primarily principles-based. What this means is the following, that when you look at US GAAP, we give you a rule. So we would say, just for example, that if the transaction exceeds 25%, you do something. You either record it as an expense or record it as an asset. Under IFRS, they might say if it is material or if it's a significant difference. So notice the real difference between the two. A rule would have they call these bright lines. So it might be something like 25%, of a certain amount. Here, you may have something like significant or major portion. Or 75%, whatever it may be. So in the US GAAP, you might say that an asset is considered fully utilized at 75%. Under IFRS, it might say an asset is fully utilized when it reaches a major portion of its useful life. So what's a major portion? Is it 60%? Is it 80%? So the difference is the judgment. Now, I think the reason why in the United States, we find principles a little bit more difficult is because you can't really prove to someone that you used good judgment, but you can prove that you follow the standard. So for me, I'm much more comfortable saying, hey, look, I didn't do anything wrong. 75%, you say it's significant or material, I got 75% or more, so I'm okay. But under IFRS, if it said a major portion, well, someone can tell me, no, a major portion is 51%, or a major portion is 60%. So that's the difference. Now, we're moving towards principles, and IFRS is not 100% principles, there are some rules as well. So the difference between US GAAP is we have bright lines, 25%, 75%, we have these rules that are easier to follow. Under IFRS, you have terms like major portion, significant, they'll just give you, and this is where you've got some judgment. So for me, of course, much more comfortable with rules, because that's the way I was trained for X number of years. But I can understand where the principles would come in. One thing I don't know at this point is if, let's say, we adopted IFRS, and let's say there's a 75% rule someplace, there was a 75% rule, now changes to major portion. How does a firm react? So let's just say Crow. Does Crow in New York say major portion is 60%? Crow in Denver, do they say major portion is 80%? So the firm is going to have to come up with a standard. So I think what will happen, whether we adopt IFRS or not, in practice you'll see there's going to be some guidelines for us to follow. But that's the difference. So this is a bigger issue in terms of audit risk, accounting risk, understanding the fact that judgment and flexibility play a very, very major role in accounting. Now, we have different methods, and there's flexibility in those methods, and we can change them. Where do we know what the company's using? Do we know what methods the company uses? And yes, the very first footnote typically could be the second note, but generally there's something called an accounting policies footnote. The accounting policies footnote is usually the first footnote. You may also see this in MD&A as well. Management's discussion and analysis may talk about these methods. Well, let's use an example. So we make this a little larger so we can see it. And this is from Walmart's 2017 annual report. So the very first footnote in most US companies provide you with what I call the portfolio of GAAP. You're going to be able to determine whether the company is using income increasing, income reducing standards, the types of standards they're using. So the first thing you'll find out in the, and by the way, if you remember the management's discussion and analysis, there's a lot of the same information here, like what does the company do, and so on. But let's look at, first of all, it tells you clearly that the standards, generally accepted accounting principles, those standards require that management make estimates and assumptions about the amounts of assets and liabilities. The management's assumptions and estimates also affect the disclosure of contingencies, and it says that actual results may differ. So immediately, the first thing you see, or one of the first things you see, is that management is telling you clearly that the statements are loaded with estimates, and once again, raising that possibility of risk. On the other side, things that you know from intro to accounting. Receivables. So it tells you that companies got various receivables net of a reserve for bad debts. That's the allowance for bad debts. And you should have picked that up in intro, right? You know that receivables are reduced by the allowance for bad debts. And they go on to talk about the types of receivables they have. And some companies will even give you information about how they estimate that reserve, but they generally don't. Here they're telling you that the receivable balance from customer credit was $1.2 billion, net of a reserve of $79 million compared to last year. So this is the allowance or the reserve for bad debts, and that's something I know you've seen. They also tell you that inventory is valued at lower of cost or market. Now, low of cost or market simply means if the market value of the inventory falls below what you expect to realize from the sale, you have to write it down. It's impaired. They also use what method? Primarily LIFO. LIFO. Now, does LIFO make sense for a retailer? Do they say the last goods in and the first ones out? Do they keep their old units in stock? Of course not. Why do they do this? Did you pick that up in intro? Why do companies in the United States use LIFO? I'm sorry?
Goods that expire?
No? Because Walmart may have some goods that expire. They may have some food products. But a retailer probably not. Yeah.
Tax purposes?
Yeah, tax, right. Because in the United States, there's a law that says if you use LIFO for your tax, you have to use it on your books. It's conforming. We'll see that at some point. But there's something known as the LIFO. It's the Internal Revenue Service. One of the few times the Internal Revenue Service has something called a LIFO conforming rule. And this is one of the few times that the government forces you to do something on your financials. So if you use LIFO for tax, you have to use LIFO for financial reporting. It's just a law that we have to follow in the United States. That is something we'll see later on in the semester when we cover inventory. But I know you've seen the LIFO method. So now I think this is going to help you understand where you're going to find the company's methods. You go to their footnotes, you'll see what they're using. They also tell us, let me go to the rest of this footnote on the next page. It says that Walmart International is primarily using retail accounting, and they use FIFO. And I don't know if you saw this in intro, but LIFO is not acceptable outside of the United States, because it generally makes no sense. You know, Kellogg's uses LIFO. So does that mean that the last cereal they produce is the first one they sell, and they leave the old ones in inventory? No. All right. So companies that have goods that expire, and I know Dan, you said, yeah, do they have things that expire? They should be using that, but in practice, you can use LIFO for, the New York Times uses LIFO. I think they're selling the newspapers when they're on the date, they're not holding the old ones, right? So it's illegal outside of the United States. So internationally, that's why you see the FIFO method being used.
Professor?
Yes?
So if they're not doing, because you said that they wouldn't leave like the old items on stock.
Yeah, physically, no. Yeah.
So then, why is it called LIFO for them?
Because they're taking, let's say Walmart has a big screen television in inventory. And let's say they paid $300 for that. And that's the current price that they have. They also, years ago, might have paid $200 for it. So they're going to assume that they sold that newest TV first, and any of those new TVs still in inventory could be valued at the old cost. So the way it would work, it's hard to imagine, but a brand new big screen TV is being valued at a price they could have paid 2 years ago. So they're assigning old dollar cost to current units. They're still moving them out the door on a FIFO basis, but they're valuing them at the lowest cost. Yeah, it's just a matter of where do you assign the dollars of inventory. It's not sensible. It doesn't make any sense to most people. Yeah, tell me.
So if a company has a business activities in out of the United States and if you create a financial statement, what kind of method do you use?
They would have to use FIFO average. They also, when you look at IFRS, they also tell you they prefer what is known as specific identification, which everyone could use now. How do you specifically identify what you have in inventory? Barcodes. You kind of just zap the code with a scanner, and you know how much you paid for that item. So you can use specific identification. But in the US, we want to get tax benefits. So in a period of inflation, it would make sense to say that the TVs you sell, and by the way, you're probably selling an old television first, but you're valuing it at the highest cost. So you will move your goods on a FIFO basis, but you'll value them at the highest price. Yeah.
Why would there be conformity on
Yeah, they just picked this one because of the, I would say perhaps the overuse, maybe even what the government would consider abusive by companies. So what companies were doing, we're going to explain this and we're going to show you there are ways to actually convert LIFO to FIFO as an account. But think about what was happening as we haven't had much inflation lately. This came from late 70s, mid 80s, where inflation was extremely high. Mortgage rates were close to 20%, if you can believe that. So the inflation was very high and LIFO became very popular. So what you were doing, showing your stockholders very high income under the FIFO basis, showing the government very low income under LIFO. And the government does look at your financials, even though you're filing a tax return which is based on different standards. And they said, wait a minute, this is getting, the discrepancy is much too large now. So we want to bring this back into parity. So if you use LIFO on your tax return, you have to use it on the financials. It's just a matter of seeing the overuse of this tax deduction. So basically, if you want the tax deduction, you got to show your stockholders the lower profit as well. But if the stockholder is reasonably informed, what do they know? They know their cash flows are higher because they're paying less taxes. So it doesn't really matter.
Would they be able to use LIFO on like their food section?
Yeah?
Yeah?
Yeah. How? They just use, in other words, they'll just use the, let's say they sell crackers that they bought last week at 49 cents a box. They buy them this week for 59 cents. When they sell those old crackers that cost them 49, they're going to say their cost of goods sold is 59. They're just going to use the new higher price to price out the old items they sell. They are going to move all the old goods. I can't imagine. There are some industries, but they're going to use the oldest price in any inventory and the most recent price for the goods they sell. And they're going to move the old ones first. The physical units will be getting the old items out first. It's a pricing game, pretty much, what they're planning. So, and we'll see that when we get, these are very good questions. We'll see when we cover inventory, we'll definitely get to those issues. We're going to show you how to convert it too. We give you enough information to convert it back to FIFO if you want. All right. And property, plant, and equipment. What method are they using? Straight line. It's the most common. They'll also give you the useful lives that they have. And they give you the property, plant, and equipment net. You'll also find, there's one more thing here I want to get to, but you'll also find, well, we know that, all advertising has to be expense, so you can't capitalize that. We're just explaining that as well. What I wanted to get to is right here. To let you know that any recent accounting pronouncements will be included either here or management's discussion and analysis. You have to show the reader or let the reader know that a new standard was passed by the FASB, which we'll talk about in a second. That new standard will affect our net income in a certain way, or we don't expect it to affect income drastically, and that has to be disclosed. So any new upcoming standards that are either applied or will be applied have to be disclosed. All right, and finally, just like us, it's the same thing as the MD&A section, they've got operating, selling, general administrative expenses. They talk about that a little bit as well. So that is the first footnote. It's the summary of significant accounting policies. It tells you the GAAP standards that the company is using in its financials. You'll be able to tell whether or not their inventory is over, undervalued, what methods they use.
I'm kind of confused with the
Yeah,
I think we all look at the same price as the currency.
yeah.
Then why do we use a LIFO?
Because so for example, think about, let's take, so let's say you've got one item in beginning inventory at $100, and you bought two items at $300. So this is the beginning inventory, and this is the purchase. All right, so now you sell one item. Sold one unit. The item perishes. It could spoil if you don't get rid of it. It's like food. Listen to food. You got some food here. I need to sell this unit. I really sell this unit, but how much do I use as my cost of goods sold? The last price in. So I sell the old unit, but I use the most recent cost to price it out. So now if I sell that for $400, what's my gross profit? If my selling price is $400, my gross profit is $100. If I use the old cost, my gross profit would have been $3, and I pay more tax. So the idea is to use the most recent cost in a period of inflation to lower your gross profit and taxable income.
Do you ever account for that old number? 100 you bought the.
Well, you just assume that that item is still, even though physically you move it, you assume it's still there. So now, at the end of this period, what you're going to have is you're still going to say you got one unit at 100, and you're going to assume you got one unit at 300. Right? Even though these units may not be the same ones you had before, you assume that one unit is still in the beginning inventory. Because you got to sell the old ones first, otherwise they'll spoil. So the problem with LIFO is that the physical flow doesn't match the actual cost. The cost flow doesn't match the physical flow. It's a mismatch. Yeah, Charlie.
So basically, they usually use the old price in the period of inflation.
That's right. Use LIFO in the period of inflation. LIFO of
The
inflation.
economy is going through deflation.
And it's the opposite. Use LIFO. Yeah, Terry brings up a good point. So let's ask this question. And sometimes I love these questions, especially like for multiple choice questions. So these are important. So it's a good one. Now you've got a period of prices falling, or your industry is facing falling prices. What are you going to use? You probably use FIFO. What industries do you think use FIFO? And it is industry specific, as we were saying before. What kind of products tend to, what was like very expensive last year is a little cheaper this year? What type of products? Yeah, iPhones, electronics, anything electronics, all this high tech, anything high tech is going to use FIFO because their prices are dropping. So LIFO would kind of backfire on them if they used it. So not everybody uses LIFO. So Walmart in retail, obviously this is a general overall for all their products. Most of their products' prices are rising. Not all, but most. All right, good question. All right, any others? Well, we are going to get back to this. We're going to spend, by the way, if LIFO was ever made illegal in the United States and taken away, we'd be done with Intermediate 1 probably November 1st. We spend way too much time on this, but it's one of those things. And I'm gonna tell you, anytime in accounting, when something really doesn't make sense, like good economic sense, it's the hardest thing because it's not intuitive, right? It lacks intuition, but it's a standard that's so popular that you've got to cover it. So anyway, we'll get there. All right, thank you. Good question, Terry. All right, so let's now move on, unless there are any other questions. We're going to talk about the FASB and these ASUs and everything else as well. All right, so here's the history of standard setting in the United States. And you might say why it's important, extremely important. You see this on the CPA exam. Not only that, but you have to know what these boards were and what they did. So first of all, everybody I'm sure knows that in 1929 we had a market crash, caused the Great Depression. By way of financial reporting, there was probably some, but not significant financial reporting. I mean, I just for whatever reason, I took a look at General Motors financial statements in 1919. Sometimes you got a balance sheet, sometimes you got an income statement, sometimes you got both. Sometimes you got footnotes, sometimes you didn't. So standards were not in existence. There were procedures and policies, but no real standards. So after the crash, SEC was formed in 1933, and in 1934, they decided that they were going to delegate accounting to the private sector. So I'm going to tell you now, even though they delegated to the private sector, the SEC still has the absolute legal authority in the United States to dictate standards. So if they wanted to, tomorrow, FASB could go away, and they could say, we're now going to dictate standards. And don't think the government and people in Congress haven't thought about getting rid of the private boards and letting the government issue financial standards. They have some, SEC has some standards, but predominantly they are delegated to these private boards. Now, let's look at the first one. The first one that was put together, which was about 5 years after the SEC, was the Committee on Accounting Procedure. The Committee on Accounting Procedure, first of all, was part of the American Institute of Certified Public Accountants. American Institute of Certified Public Accountants, AICPA. They were the sponsor board for the CAP. They lasted 20 years, and they issued standards that were called bulletins. Okay, accounting research bulletins. They're actually below, so let me just move that up so you can see. Okay, ARBs, or accounting research bulletins. Now, there were 51 of these, and you don't see much reference to the bulletins in any accounting literature for a very important reason. First of all, what was the purpose of the CAP, of the Committee on Accounting Procedure? They were put into place to narrow the number of alternatives and actually create standards. So they're the board that now tells you got to use LIFO, FIFO, and weighted average. That was the board that told you you could only use straight line, declining balance, and maybe some of the year's digits. So they narrowed the number of practices that could be used. They narrowed the number of practices, and that was their charge. In 1959, also part of the AICPA, there was the creation of the Accounting Principles Board. Now, the Accounting Principles Board was put into place after Committee on Accounting Procedure accomplished its objective. So the Committee on Accounting Procedure, again, was put into place in order to narrow the number of alternatives that we're using and creating an actual set of standards. Accounting Principles Board, their charge was to try to build future standards, or in other words, to try to find standards that would prevent abusive practices, that would anticipate changes in the economy. They didn't do that for a lot of reasons. Number one, this was a part-time board. They were all CPAs, and they were all partners in public accounting firms. So there was a problem in the sense that it was sort of a conflict of interest. For example, if the Accounting Principles Board is voting on a standard that would influence your client's net income adversely, you might vote against it. Now, I'm not saying you would, but there's an inherent problem here. So they didn't really move very quickly. They issued what were known as opinions. They issued 31 opinions. You will see reference to those from time to time, the APB opinions. There were only 31. And notice how slow they moved. I mean, they moved pretty slowly. They were around for a long time. Now, this is a part-time group, only CPAs. Also, they didn't have to leave their jobs. They were partners in other firms. It was a big problem that was looked at. It was also part of the AICPA. 1973, you might have heard Michael introduce Cohn yesterday and said at one point they were Cohn Horwath. There was a firm that was part of Horwath, but there was a major accounting irregularity in 1973. The call was to have government take over accounting. Did not happen. Rather than taking over accounting, the Financial Accounting Standards Board was created. So it is not affiliated of the AICPA. It is actually sponsored by the Financial Accounting Foundation, which we'll talk about. It is a full-time board. So everybody has to quit their jobs. So if you're a partner with Crow, you have to quit if you want to be on the FASB. Includes CPAs, people in finance, people in government, education, and so on. You can come finance. You could be a financial analyst. You could be whatever position you're in, you could join the FASB. So there's a much broader representation of industry, and you're full-time. Now, they've been in operation since 1973, and they issue what are known as accounting standards updates. They are too numerous to mention. The FASB has been charged with, again, trying to meet the needs of a changing environment, trying to attack problems as soon as they come about. They're doing a much better job than the Accounting Principles Board. There is also something known as a codification. This codification includes any remaining bulletins, opinions, and FASB standards that are still in effect. Every time the codification changes, you get an accounting standards update. And what does the codification mean? It means they took all of these standards and put them into one place. So I'm going to give you an example. If I was looking to determine how to account for inventory before the codification, I might have to look at a bulletin, and then I got to find another opinion or a FASB. Rather than doing that, they stripped away all of these titles, and now inventory is in one place. And I think if I haven't done so, I can give you access to the codification. Not that you're going to be using it right now, but you might at some point be in need of that. We do have free access to the codification, where you would just go in and you drill down. You can go through inventory, every standard that is currently in effect. And since it's a real-time body of information, it's always updated. So if the standards change, you go right in and you can. It's almost like the IRS code in a sense. It's the accounting standards codification. This was put together several years ago, and it is extremely, extremely effective for research, and it keeps us up to date. So that's where we are right now. The board that is in effect is the Financial Accounting Standards Board. They issue updates into the codification. Yeah.
Why
sure.
did the SEC
They felt that accountants would be better suited to handle their own profession. That's a good question. So why did they defer? The government felt that they were not at that point, in particular with the SEC just starting the year before, they did not think they were in any position to effectively create accounting standards. And they thought they'd leave it up to the profession to do that. And they haven't, and again, they have veto power. So if the FASB issues a standard, they may object. The SEC also sits on some of the committees on the FASB. So they do have input, but they kind of have a hands-off attitude.
So we have changed where they give back to.
Good. I mean, this was, at this point, when there was that accounting irregularity that occurred in '73, the government, some people in Congress were calling for the take back of the accounting function by the government. Just have the SEC promulgate all the standards. And not only that, just don't forget, not everybody's publicly traded. So you do need a private board to handle those smaller companies. By the way, in the Enron case, and even in the recession, it was also brought up again. The government did take over auditing. They took over the auditing standards. There's a public company accounting oversight board, the PCAOB. After Enron, government did take over auditing. They took auditing away from the AICP. I'm going to explain that to you in a second. So it could happen, because I mean, it's going to, but it could. All right, so now let's see what the FASB looks like. And the FASB has two main arms, the FASB, that's the Financial Accounting Foundation, and the Government Accounting Standards Board. We're only worried about the FASB. And notice the Financial Accounting Foundation, that's the board or the body that provides the funding for the FASB. Now, where does the FAF, the Financial Accounting Foundation, get its funding from? Corporations. So that kind of leads to a little bit of a possible conflict of interest. Corporations pay the FAF in contributions. But the FASB is the board that we look at. There's also an advisory council, government accounting standards are separate. Private company council, small companies. Privately held companies have different standards. You might hear the term big gap, little gap. Little gap is for privately held companies. Privately held companies do not need the level of disclosure that a publicly traded company needs. So as a result, the standards will be a bit different. So for example, you get less disclosure on something like earnings per share. Why would you need earnings per share for a privately held company? That's information that's disseminated to the public and drives stock price. So if you're privately held, you will not need to follow certain standards. Now, are there private companies that are very large? Yeah, Goya Foods in New Jersey is a privately held company. It's a huge, huge corporation. Ford, every once in a while, goes private. They buy up all the stock and the family owns the business. They don't want anybody outside controlling the business. So you could have some very large companies. They don't have to be very small, but they're privately held. Usually they're smaller companies, and they have less disclosure because they're not disseminating information to the general public. There are differences too in accounting for certain assets. Anyone remember goodwill, the intangible asset? Anyone hear of it at all? Do you amortize goodwill? Yes or no? Do you remember? Does goodwill get amortized as an intangible? Anyone remember that? Well, the answer is no. It does not get amortized, except if you're a private company. The private companies amortize goodwill over 10 years. So we'll get to those differences. But that's one I thought you might be familiar with. That's one I thought you might And finally, the EITF, the Emerging Issues Task Force, up on top, that is a group that meets extremely often to attack current problems. Something happens in the economy. So for example, during the recession, companies were stuck with toxic assets, bad mortgages. What are we going to do with them? Do we tell them to write them off, take huge losses? What would happen if financial institutions holding all of those toxic mortgages had to take those huge write-offs? It would cause more of a shock to the market and make the recession even worse. So the Emerging Issues Task Force gets together and decides on ways to avoid the write-offs. They said if you're going to hold the asset, as long as you're not going to try to liquidate that receivable, if you're going to hold on to it until maturity and maybe until you can sell the assets as collateral, you don't have to take the write-down. So it avoided these companies taking huge hits on their earnings. And that they meet instantly when there's a problem. The SEC serves on that task force, as well as members of the AICPA. So it is really a functioning workforce type group that meets often to attack these emerging problems. And then finally, I just want to remind you that, again, we've got this codification, and the updates, ASUs go into the codification. One last point, I want you again, I think you've heard this, but just to be sure, auditing standards. And I know you haven't seen auditing yet. We're under the AICPA as part of the changes with Sarbanes-Oxley, with the Dodd-Frank and all those laws that came into effect after Enron. AICPA no longer issues auditing standards. It's the PCAOB. It's the Public Company Accounting Oversight Board. PCAOB, Public Company. So here's an example, and Tony asked me the question before. Private sector no longer issues audit standards, and is now the government's responsibility. So that's something they might have felt that we dropped the ball on with Enron. That's the background. And the FASB is probably not going anywhere anytime soon, so you can expect more of these updates. All right, so any questions? We had some good questions, good discussion on this, so any other questions? All right, one last aspect here, and then we're going to move ahead. And what we want to look at is the environment of accounting. And just to let you know that accounting, and again, the setting of standards is a political process. So we know there are legal, economic, social, political factors that impact accounting. You have to realize that accounting and the standard setters are basically responsible for interacting with their environment. And they are reactive and proactive. They interact. So they react to pressure from various lobbying groups and changes in the economy. Things like oil and gas accounting, lease accounting, as you'll see, accounting for derivatives, fair value accounting that has changed, accounting for special purpose entities, moving now more to a balance sheet focus. We'll talk about this. You would think that the primary statement is what? The income statement? We're now moving towards a balance sheet focus in accounting, which we'll see. already mentioning IFRS principles versus rules. These have been influences on accounting. I can tell you that, lease accounting recently changed because of the demands from financial analysts. Certain types of leases were not on your balance sheet. When you lease a car, it's like buying an asset, right? And you have payments to make. It's like borrowing money. Certain types of leases years ago, about 2 years ago actually, no, I shouldn't say that, that's a standard. Actually starting this year, the new standard kicks in. We're putting leases on the balance sheet. We don't care how long they are, 1 year, 2 year lease, we're putting them on the balance sheet. This was kept off balance sheet, meaning that, as ridiculous as this may sound, and more ridiculous than LIFO, you could take Continental Airlines, and you could be taking one of their large jets on vacation. If that jet is leased, it may not show up on their balance sheet under the old standards. And the debt from that lease may not show up on your balance sheet. Now, starting this year, the new lease standard will put that debt on the balance sheet along with the asset. So we make corrections as we move along. Fair value accounting. You're going to find out, I think you know that some assets are valued at fair value in the United States. Not all of them, but some are. This was something that the SEC was against going back to the history, because after the stock market crashed, they blamed the use of fair value and speculation on the market crashing in 1929, and that's when the historical cost concept came in, where it was believed that historical cost was more objective and verifiable. Now we use more fair value accounting. So fair value accounting is now back, and that's because we have better disclosures, and we'll talk about that as well. We also know that we already saw this, and you heard it from Crow yesterday as well. Accounting will conform to environmental, legal standards, social standards as well. And we're going to show you in a minute how the development of accounting standards is a political process. Now, how do you react? Well, accounting is proactive, that is reaction. Rather, here's being proactive. We provide feedback information that companies make decisions on. Individuals make decisions. We allocate resources. The other one that you might find interesting is that management behavior could be changed. So the idea that we now expense all research and development, some people say, well, maybe because we know it hits bottom line, net income, you might cut back a little bit on research. The one that I also wanted to mention is that we now expense employee options. This is something that we'll see in Intermediate 2. Up until Enron, actually, stock options were not expensed. So you could be paid $1 as an executive and paid in options. Stock options were not considered to be compensation expense. So you could have someone that is being paid millions of dollars, but that person's salary wouldn't appear on the financials because we felt we gave them nothing. We just give you a share of stock, or an option to buy the share of stock. So if I give you an option, it means, let's say you could buy the stock for $10, and let's say it trades today at 10, what do I give you? I'm giving you the option to buy the stock at 10, but the market price today is 10, what do I give you? Well, we gave you something, but accountants would say nothing, and we kept it off the income statement. Now we have to expense them, and we're finding that managers are giving up on employee options and they're using other forms of compensation like restricted shares. So accounting can be proactive and can impact management. And then finally, there is a political process in setting standards. And all of these parties have input, the financial community, CPAs, AICPA still has some influence. The government, preparers of financial statements, academics, they all have influence on the FASB. And how do they influence the FASB? Well, here is the standard setting process. Again, you don't have to memorize this, but you have to know certain things, and I'll tell you what those are right now. Number one, there's a 7-step process right now to issue a new accounting standards update. The first thing is you identify the issue. Second, you decide to pursue that issue. And step number 3, you hold public meetings. And that's where all of these parties will vote. So I can go to the public meeting and raise an objection to the new standard. A corporation could go in, raise an objection or support the standard. 4, an exposure draft. This is a first draft of the standard itself. That gets released for comments. So once again, you're going to have those parties commenting on the standard. So we've got to know that step 3 and step 4 have votes, in a sense, voting from the public. Then they hold public roundtables where people will discuss the exposure draft if needed. So in steps 3, 4, and 5, you've got the user groups having input into the standards. The final standard is only passed if all of these issues are resolved. So everyone's got to vote, in a sense, for the standards. So the standards are not dictated, the standards are a result of a political process. The final standard will be, again, based on the redeliberation. We consider all of the comments from the general public. All right, so